There's not one on every corner, so to speak. Does that make sense? And then large companies, ExxonMobil, Procter & Gamble, Google, Apple, Facebook, Amazon. Those are considered large companies. Cap means capitalization, as you were referring to earlier, meaning what is the company worth? If I took all the shares outstanding of that company times the stock price, that's what the company's worth on the open market. Does that make sense? So some of these companies are worth trillions of dollars today, hundreds of billions. Questions? Nope. Okay. So these are market indices. This is how you follow stocks. So instead of your eyes glazing over because I know the fried chicken was really heavy, I'm kidding. Here's a little story. In 1917, there was a guy named Henry Dow, and the other guy's name was Jones. And they had this little fledgling newspaper, it was called the Wall Street Journal, and they wanted to come up with a way for investors to measure the stock market. So they have one of these what if moments. What if we took one share of stock, the price of one share of stock of 10 of America's largest companies? And the Dow Jones Industrial Average was born in 1917. It's since expanded to 30 of America's largest companies. Now, there are 6,000 publicly traded companies in the United States. So 30 companies does not make a stock market, yet it's the most widely quoted one. You hear it on the news. The Dow Jones Industrial today was down. You know what I'm saying? You've heard that, right? Now, the Standard & Poor's 500 is 500 of America's largest companies. It's an index of that. Right? There's also the Russell 2000 and 3000 of 3,000 or 2,000 of America's largest companies. Right? Why is this important? Because if I put money in a 401k plan or some sort of retirement plan at that job I'm going to get eventually, and some people will tell you just to put the money in a stock index fund and forget about it. Well, there's your indexes. Does that make sense? It also measures the direction of the stock market as a whole. Questions? No? On a day-to-day basis, stocks can be influenced by North Korea, it can be influenced by the president, it could be influenced by Russia, it could be influenced by somebody sneezing wrong. Over the long term, remember what stock is? What is it? Ownership. And if the company makes money, what happens? Stock goes up. Company doesn't make money, what happens? Stock goes down. Think of Costco. Costco sells a lot of toilet paper. Guess what happens to Costco stock? Does that make sense? Okay? On a day-to-day basis, and I tell people, you know, when the markets go down, if you're investing for the right reasons, put the phone down, turn off the TV, right? This too shall pass. The world's not coming to an end, film at 11. It's really not, right? Trust me when I tell you in your lifetimes in this room, you will see at least 2 full-blown market crashes before you retire. At least 2, right? Where it's just earthquaking, jaw-breaking, whatever it is, film at 11. It'll be all over TV, all over your pad, all over the phone, all over everything. Shut it off. Put it down. When I save money and I invest money, it's for the long term. It's not for, if I need money 90 days from now, I'm not going to put it in the stock market. Does that make sense? I'm going to do it for my retirement planning. And when I start saving for retirement, it's a marathon. It's not a sprint. So you're going to see at least 2 full-blown market crashes in your lifetime. Don't panic, right? Just, remember this, it's only a loss when I sell it. Does that make sense? If I buy a house for 100 grand and it goes to 50 grand, I've lost 50 grand, or have I? On paper I have. It's only a loss if I sell the house. And then eventually the house goes to 150 grand. Does that make sense? It's only a loss when I sell it. Questions? Nope. Okay. There are 2 different ways of valuing stocks, and you'll find this in retirement plans. You'll see a growth fund or a value fund. We'll talk about what funds are here in a second. A growth money manager says, I'm going to buy Apple today because you know what? I don't care if it's overvalued in price or not, because I know that they're going to make a ton of these and they're going to sell a ton of these, and it's going to be worth more 5 years from now than it is today. That's what a growth money manager does. A value money manager says, I'll wait for it to go on sale. Right? Anybody heard about scandals in Wells Fargo lately? Opening accounts when they shouldn't be, selling stuff. Did you have?
I wasn't, but I do go. I used to have a Wells Fargo account.
Okay, yeah, so did my wife too. But if I'm a value money manager right now, I'm probably taking a look at Wells Fargo, because it is, after all, they and Chase are the largest banks in America. So they're not going anywhere. But I'm going to buy it on the cheap. I'm going to buy it on sale. Remember, probably about 5-6 years ago, Toyotas were going places they shouldn't be going. There was acceleration issues with Priuses, Lexus, things of that nature. I've driven a Toyota for 20 years. I've never had a problem with it. But here comes the obligatory bad press, lawsuits, and what happens to the stock price? It goes down. This is Toyota after all. So if I'm a value money manager, I'm buying that. I'm buying on the dips. That's what a value money manager does. So a growth money manager says, I don't care, right? I'm buying it because even if I think it's overvalued, 5 years from now it's going to be worth more than it is today, right? The value money manager says, I'll wait for it to go on sale. That's value versus growth. There's two different ways of buying stock, two different ways money managers will buy stock. Questions on that? Nope. Okay. See the squiggly line? That means one day you're going to make a lot of money. That's actually the value of $1 in the Standard & Poor's, invested in the Standard & Poor's 500 from 1976 all the way to the end of 2016. Is that a straight line? No, it's not. Right? And you can see the market crash in 2008. It's volatile and it's not guaranteed. But what I own has the opportunity to create wealth for me over time. Key word is time. Make sense? Question? Nope. Okay. A mutual fund. Anybody kind of know what a mutual fund is, and you could expand this to an investment choice inside of a retirement plan? Anybody know? Anybody?
That'd be like Vanguard?
Yeah, Vanguard, T. Rowe Price, Fidelity, that sort of thing. They're all mutual fund firms. TIAA, which is one of the retirement options here, is a mutual fund firm. Something like that. Make sense? Here's a simplistic explanation. Who wants to be a volunteer? Anybody? You want to be a volunteer all the way in the back? What's your name?
Marion.
Marion. I love the SOU shirt on campus here. That's pretty cool. So Marion, we're going to make you a money manager.
Okay.
So what I need everybody to do right now is take $1 out of their purses or wallets, please. So if everybody would take $1 out. I'm serious. Come on, let's go.
I don't care.
Marion needs $1. I'm not kidding. Let's go. I'm kidding. Half you don't have $1. No, I'm kidding. But let's say we all gave Marion $1. And Marion went out and bought fried chicken. Congratulations, you all bought into a fried chicken mutual fund. It'll be Marion's skill in buying and selling that fried chicken that will determine whether you get 80 cents back, which is a 20% loss, or whether you get $1.20 back, which is a 20% return. Does that make sense? That's a very simplistic explanation of what a mutual fund is. People pool their money together, a money manager is hired, and his or her job is to buy stocks if it's a stock fund, bonds if it's a bond fund, and to make money for who? You, the people who put money in the fried chicken fund. Remember that? That's a very simplistic explanation of what a mutual fund is. Marion, thank you very much, by the way. We will greatly reward you with more fried chicken, but questions on that? Right, so if it's a stock fund, bond fund, it could be an international fund, which would buy stocks and bonds international. Fixed income is a bond fund. I can have a government bond fund. A high yield, what is high yield? Junk bonds. It's a euphemistic term. Remember what an app? 22% interest? Right? It's a junk bond. And what is a junk bond? A junk bond is a bond that's rated by rating services. The company is considered below investment grade. So it's kind of like somebody who has a really bad credit score. So maybe your FICO score is like 500 or 450 or something like that. If I'm AAA, maybe I'm 800. But if I'm, a junk bond, maybe my credit score is like 400, 350, which means I never pay my bills, right? But that's why they're called high yield or junk bonds, because, they're not highly rated and they have to pay you more interest to entice you. Go back to what an app, 22%. Does that make sense? If I'm highly rated like a Ford, I don't have to pay 22% as a bond. But there's all kinds of funds, stock funds, bond funds, etc. And here's the question is, do I stick all my eggs in one basket? No, I don't. Why? Because this is kind of a chart that says who were the best performers in any given year. And in 2009, it was emerging equity markets. Emerging markets equity, which is a fancy term for international. So if I had my money in an international fund, I made out. Small companies in 2010, government bonds in 2011, so on and so forth. So I don't want to stick all my eggs in one basket. I want a little bit here, a little bit there, a little bit here, a little bit there, stuff like that. Does that make sense? Questions? What is a stock? Say what? I can't hear you.
Ownership.
What is a bond? Okay, I just want to see if the fried chicken, So, this is called a target date retirement fund, and I added this today. This is what you'll find in what I represent, which is the Oregon Savings Growth Plan for state employees in the state of Oregon. These are called target date retirement funds. And this is important because when you go to work and that company has that 401k or 403b if it's nonprofit, or 457 if it's government, again, they're all the same, right? They will offer these. Back about 12, 15 years ago, the financial industry finally figured out that people weren't really saving for retirement because they were scared to death of stock and bond funds, because they didn't know what a stock was, they didn't know what a bond was, and they were scared to ask. And up until 2005, it was against federal law for your employer to give you financial advice, even on your own retirement plan. That's changed, but many employers still won't because of the liability involved. So they came up with this. This is called a Life Path Fund. In Fidelity, they're called Fidelity Freedom Funds. In TIA, they're called Life Cycle Funds. Everybody's got a brand name for them, but they're called target date retirement funds because it might target the date when I might want to retire. This one's in 2055. So how many years is that from now? Do the math. Chicken can't be that heavy, come on. How many years from today is 2055? Huh? 28 years from now. Is that about right? So that's a working career, isn't it? 28 years? I might want to retire after 28, 30 years, something like that. Does that make sense? Okay? So, if I have a retirement plan at work and they offer this type of thing, I'll put my money in the 2055 fund. Right now, this is a very aggressive fund. If you look at the pie chart, it's all stocks, no bonds, a lot of overseas, a lot of smaller companies. Why? I'm retiring 28 years from now. Market goes down a couple of times. What do I care? Remember, it's a marathon, not a sprint. Now notice as it gets closer and closer to the year 2055, you see that Nickelodeon green on the pie chart? Those are government bonds, government and corporate bonds. As it gets closer and closer to my retirement date, we're selling stocks, we're buying bonds. I don't want the stock market crashing 18 months before I retire, and poof, there goes a third. Does that make sense? We spend a lifetime accumulating stuff. At one point in our life, we want to start preserving what it is we've accumulated. Does that make sense? Right? So these are called target date retirement funds. So if I want to retire in the year 2030, I'll put my money in that. Now, do I have to keep this till the year 2030? No. I can get rid of it tomorrow in my retirement plan. It's the money managers who are managing this for folks who want to retire in and around that particular year. As it gets closer and closer to today's date, like is that Life Path or Life Cycle or Fidelity Freedom Fund 2020 fund, it's a lot more conservative. It's mostly 50% stocks, 50% bonds. So what does that mean? Say what?
You have loans and.
Yeah. So what does it mean? It means practically, it means in all practical terms, it means if the stock market's up here in a 2020 fund, half stocks, half bonds. If the stock market's up here, I'm here. If the stock market's down there, I'm there. I'm not fully participating either way. Now that doesn't mean I can't lose money, I'm just not gonna lose as much as everybody else. Does that make sense? These are target date retirement funds. You see them more and more. So when you go to work, you get a 401k, 403b, it'll have a name and it'll have a year next to it. And now you know what they are. Sometimes these funds, these investment choices are called set it and forget it. I don't like the term. I don't like the term because it kind of conveys a false sense of security. After all, this is your money. You should pay attention to it. You know, visit it every once in a while. Make sure it has enough food and water, you know, stuff like that. Questions?